Did you know that when Facebook went public in 2012, it created more than 1,000 new millionaires overnight? Most people think companies go public just to raise money, but that's only part of the story. The real secrets behind an IPO are rarely told, and today I'm going to decode them for you. If you've ever wondered why companies rush to list their shares on Wall Street, stay tuned because the truth might shock you. This is the Finance Decoder, and we're about to uncover the hidden game of IPOs. An IPO, or initial public offering, is when a private company sells its shares to the public for the first time. Before an IPO, only founders, employees, and private investors like venture capitalists own the company. Once the IPO happens, anyone with a brokerage account can buy those shares on the stock market. It's like opening the doors of a private party to the entire town. But the big question is, why do companies choose to do this? Most people think companies go public because they need cash, and while that's true, it's not the whole truth. Going public is also about prestige, branding, and giving early investors a chance to cash out. When Uber went public in 2019, it wasn't because they were broke, it was because their private investors wanted an exit. IPOs create liquidity, which means those early investors can finally sell their shares for real money. So remember, IPOs are not just about raising funds, they are also about rewarding those who believed early. Every IPO involves several big players who make it happen, and you need to know who they are. First, there's the company itself, the one going public. Then come the investment banks like Goldman Sachs and Morgan Stanley who underwrite the deal. They set the price, take a big fee, and sometimes even buy shares to stabilize the stock. And finally, there are the regulators like the SEC, making sure everything follows the law. The biggest reason companies go public is to raise a huge amount of money fast. With an IPO, they can collect billions of dollars in just a single day of trading. This money is often used to expand the business, pay off debt, or fund new projects. For example, when Airbnb went public in 2020, they raised over $3.5 billion even during a pandemic. So for companies, IPOs are like a giant payday that can supercharge their growth plans. But here's the secret most people don't know. IPOs are also a way for insiders to cash out big. Founders, early employees, and venture capital firms have been waiting for this moment for years. They bought shares when the company was private at a super low price, and now they can sell them for a massive profit. This process is called an exit, and it's one of the main reasons IPOs happen. So next time you hear about an IPO, remember it's not just about raising money, it's also about insiders getting rich. The price you see when a company goes public is not random. It's set by investment banks. These banks work with the company to decide the offering price, which is the price at which shares will be sold on day one. If the price is too high, the stock might crash. If it's too low, the company leaves money on the table. That's why these banks do something called a roadshow, where they pitch the IPO to big investors before it hits the market. This process helps them figure out what big institutions are willing to pay. Have you ever seen a stock jump 50% on its IPO day? That's called an IPO pop, and it usually happens because the offering price was set lower than what the market is willing to pay. Big investment banks do this on purpose to keep their institutional clients happy. Those clients get shares at the low offering price and then sell them for a huge profit on day one. This is one reason regular investors often feel like they missed out on the best gains. Retail investors like you and me usually can't buy shares at the IPO offering price. That's because those shares are reserved for big institutional investors like mutual funds and hedge funds. By the time regular investors can buy, the stock has already popped and become expensive. This is why chasing IPOs often leads to disappointment for small investors. The system is designed to favor big money players from the start. Here's the scary part. Not every IPO is a success story. Some stocks crash hard after the hype fades, leaving late investors with big losses. Remember WeWork? They tried to go public, but their valuation collapsed because investors realized the business wasn't as strong as advertised. Even companies that do go public can tank after a few months if they can't deliver profits. That's why understanding the risks is just as important as chasing the rewards. Wall Street loves to build hype around an IPO because excitement drives demand. You'll see headlines saying things like, "The next big tech stock," or "Don't miss out." This hype makes people feel like if they don't buy now, they'll regret it later. But here's the truth, most of that marketing is designed to benefit the company and the bankers, not you. As an investor, falling for hype can lead to buying at the wrong time and losing money. FOMO, or fear of missing out, is one of the biggest traps in the stock market. When you see others getting rich on an IPO, your brain screams, "Don't miss this." But buying out of fear instead of logic is a recipe for disaster. Many people buy at peak prices only to watch the stock drop after the excitement fades. Smart investors know patience beats panic every single time. Here's something Wall Street rarely talks about: the lockup period. After an IPO, insiders usually can't sell their shares for about 90 to 180 days. Once that lockup expires, a flood of insider shares can hit the market, pushing the price down. This is why some IPO stocks crash months after the initial excitement. If you don't know about lockups, you might buy high and then see a sudden drop later. Analysts and financial media often hype IPOs to attract more attention. They'll appear on TV saying things like, "This stock could double in a year." But remember, many analysts work for the same banks that underwrite IPOs, so their opinions may not be unbiased. Media companies also love IPO stories because they get clicks and views. As an investor, always question who benefits from the hype before making a decision. Not all IPOs turn into success stories. Some become disasters. Take Rivian, the electric truck company, which went public in 2021 at a huge valuation. Within a year, its stock crashed over 80% as production and demand problems surfaced. Investors who bought during the hype lost billions. This proves that price and potential are not the same thing in the stock market. Another example is Beyond Meat, which had one of the hottest IPOs in 2019. The stock skyrocketed more than 160% in the first few months. But as reality set in and competition grew, the price collapsed from over $200 to under $20. Early buyers who didn't sell lost almost everything. The lesson? Never confuse early excitement with long-term success. The best investors don't chase hype. They wait for the right price. Warren Buffett never buys IPOs because he says you don't need to rush to make money. If a company is truly great, there will be chances to buy later at a fair value. Jumping in blindly just because everyone else is doing it is a recipe for disaster. Remember, patience is a superpower in investing. Before you buy an IPO, ask yourself one question: would you still invest if you had to hold it for 5 years? If the answer is no, then don't buy. IPOs are not a lottery ticket. They are a commitment to a company's future. If you're not confident about its long-term potential, walk away. Smart investing is about discipline, not impulse. IPOs can influence the entire stock market because they pull in a lot of investor money. When a big IPO happens, like Facebook in 2012 or Airbnb in 2020, billions of dollars shift from other stocks into the new one. This can temporarily affect prices across the market. For traders, this means volatility increases during major IPO weeks. Understanding this helps you avoid getting caught in unnecessary turbulence. Sometimes companies announce an IPO but later delay or cancel it. This usually happens when the market is too volatile or the company fears a poor valuation. For example, WeWork planned an IPO in 2019 but canceled after investors questioned its business model. The company's value collapsed from $47 billion to less than $10 billion. Timing matters as much as the company's story when it comes to going public. IPO investing is often driven more by emotion than logic. People fear missing the next Amazon or Tesla, so they rush in without research. This herd mentality creates dangerous bubbles that can pop anytime. Smart investors detach emotions and stick to data before investing. Remember, the stock market rewards discipline, not desperation. Let's look at two sides of the IPO coin: Google and Pets.com. Google went public in 2004 and turned early investors into millionaires. On the other hand, Pets.com launched in the dot-com bubble and went bankrupt within months. Both started with excitement, but only one had real business fundamentals. This shows that brand hype is temporary, but solid companies last forever. Retail investors often get the short end of the stick in IPOs because they buy after the price has already jumped. To protect yourself, avoid rushing in on day one. Instead, wait a few weeks or months to see how the stock stabilizes. This strategy helps you avoid paying inflated prices driven by initial hype. Remember, you don't need to be first, you need to be right. Before you invest in any IPO, check the company's financial health, debt, and growth prospects. Read the prospectus and understand where the money will be used. Look for red flags like excessive losses or vague business models. Compare valuation with competitors to see if the price makes sense. Finally, ask yourself, does this fit your long-term strategy, or is it just FOMO? IPOs can create wealth, but they're not the only path to success. Most millionaires in America didn't get rich from IPOs. They got rich by consistent investing in solid companies over time. Chasing the next big thing often leads to stress and losses. Building wealth is about patience, discipline, and a plan that works even when markets are unpredictable. If you master these principles, you'll win the money game without gambling on hype. So now you know the secrets behind IPOs that Wall Street doesn't tell you. If you found value in this video, hit that like button and share it with someone who's thinking about buying an IPO. Subscribe to the Finance Decoder because we decode money in ways schools never teach. In our next video, we'll reveal the truth about stock buybacks and why CEOs love them. Until then, stay smart, stay patient, and keep decoding finance.